Hook and promise. When the Federal Reserve raises or lowers interest rates, it feels like a mysterious force shaking your entire portfolio. Stocks jump or plunge, bonds react, and suddenly your net worth seems to dance to a tune you can't quite hear. But what actually happens when the Fed tweaks those rates? Today on the Capital Breakdown, we're cracking open the mechanics behind interest rates and how they ripple through stocks, bonds, and yes, your money. By the end, you'll understand why rate changes matter, how different assets respond, and most importantly, how to keep your financial footing steady when the economic winds shift. The problem or confusion. Most people hear about rate hikes or cuts and think it's just the headline for economists or Wall Street traders. But for everyday investors, it's often confusing. You might wonder, if rates go up, should I sell stocks? Are bonds safer? Why does my mortgage rate change? It's like hearing rain is coming, but not knowing if you need an umbrella or boots. The truth is, we all interact with interest rates, whether through credit cards, loans, or investments. But the effects aren't always straightforward. Without a clear picture, it's easy to feel overwhelmed or make reactive decisions that don't align with your goals. Core concept explained. Let's break it down. Interest rates are basically the price of borrowing money. Think of them like the cost of renting cash. When the Fed sets its benchmark rate, it influences how expensive or cheap it is to borrow. Imagine a system of pipes carrying money flows. When rates rise, it's like tightening the pipes, making cash flow a bit harder to access. When rates fall, the pipes open wider. Stocks, bonds, and other assets are like vessels connected to those pipes. Bonds are fixed income vessels paying steady interest, so higher rates can make new bonds more attractive but lower the value of old bonds paying less. Stocks, on the other hand, are more complex because their value depends on future profits discounted by those rates. The key is that rates help set the baseline for what investors expect to earn elsewhere, influencing how risky or rewarding different investments feel. How it actually works. Behind the scenes, the main players include the Fed, commercial banks, institutional investors, and everyday investors like you. When the Fed adjusts rates, banks change their lending rates, which affects consumer and business borrowing costs. Investors watch these moves closely to adjust their portfolios. Fund providers and brokers facilitate trades, moving money between buyers and sellers. This flow isn't instant or frictionless. There are fees, bid-ask spreads, and market psychology at play. For example, if rates rise, bond prices often drop because newly issued bonds pay more interest, making older, lower-yielding bonds less valuable. Stocks might react differently depending on sectors, like utilities versus tech, because their cash flows and growth prospects respond differently to borrowing costs. This interplay creates the dynamic environment your portfolio lives in. Simple, concrete examples. Picture two investors. First, someone contributing monthly to a broad stock market index fund. When rates rise, this investor might see short-term bumps or dips in the fund's value. But because they're investing consistently over time, they're buying shares at varying prices, smoothing out volatility. Second, imagine someone trading a single speculative stock. That stock's price could swing wildly as rate changes alter investor appetite for risk and growth prospects. This trader might feel more stress and temptation to react quickly. Both examples show how rate moves affect your portfolio differently depending on your approach. The key takeaway? Understanding these dynamics helps you manage emotions and stay aligned with your long-term plan. Risks, traps, and common mistakes. Here's where many stumble: chasing quick returns during rate changes or over-concentrating in single stocks or sectors sensitive to rates. Leverage, borrowing to invest, can amplify gains but also magnify losses, especially in volatile rate environments. Ignoring your time horizon can lead to panic selling when markets dip. Remember, rates cycle through highs and lows over years, and reacting to every move risks missing the bigger picture. Patience, diversification, and realistic expectations are your best friends. Volatility isn't just noise, it's a natural part of investing that tests your discipline and strategy. How to think about this tool. Interest rates are a powerful economic tool, but they're just one piece of your financial puzzle. Before adjusting your investments based on rate news, it's important to have a solid budget, an emergency fund, and clear goals for retirement or major purchases. Think of rates like the weather forecast, useful to prepare, but not to control your whole day. A well-constructed portfolio considers your risk tolerance, time horizon, and need for liquidity. By understanding the role rates play, you can better anticipate how different assets might respond, but always anchor your decisions in your personal financial landscape. Recap and educational disclaimer. So to wrap up the capital breakdown on how interest rates move your portfolio, first, rates represent the cost of borrowing that influences all asset prices. Second, stocks and bonds respond differently because of their unique cash flow structures and sensitivities. Third, understanding these effects can help you stay calm and focused during market shifts. Remember, this video is purely educational and not personalized financial advice. Always do your own research and consider consulting a qualified professional before making investment decisions. Thanks for joining me today. Keep learning, stay curious, and take confident steps toward your financial future. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.